Hello guys, it's Samuel here. Today we'll be busting the common myth that portfolio volatility is directly associated with risk. While it is critical to manage volatility and more importantly risk in one's portfolio, understanding this dynamic can help form successful trading strategies and mitigate risky behavior. Volatility and risk are not synonymous. Low volatility does not imply low risk, and high volatility does not imply high risk. Investments that are subject to sporadic, large risks appear low volatility if a risk event is not present in an existing track record. For example, selling out of the money options can appear low volatility if there are not large underlying price moves, but the risk increases in the event of a steep sell-off. On the other hand, with occasional large gains, volatility appears high, but that does not correspond to more risk as it was unidirectional rapid growth that can be found with an asymmetrical strategy of trades, and it is clear that upside volatility should be looked at favorably. A common way to measure risk in a portfolio, taught by economists and found in most investment literature, has to do with the Sharpe ratio. This ratio is used to measure risk, but takes performance and divides by volatility in one's portfolio. There's a critical issue with this calculation, as an alternative ratio to track trading performance and identify the best strategy for you would be the gain to pain ratio, which only uses downside volatility as risk. The gain to pain ratio can be calculated by monthly ROR or trade by trade data. It takes the cumulative total of all returns on risk and divides by the absolute value of cumulative negative monthly ROR. The gain to pain ratio measures exactly what it describes, the amount of pain required to achieve some level of profitability. The gain to pain ratio preferably should be maintained for multiple years, although maintaining a running 1-year data set is a great way to statistically identify abnormal performance periods. A gain to pain ratio of 1 is good, above 2 is excellent, and above 3 is world class. Understanding this metrics allows you to understand what to target for exceptional risk-adjusted returns. The key here is in generating a high gain to pain ratio. To do this, you not only have to target high positive returns, but having small downside losses as well. Some ways to ensure this are cutting losses quickly and letting winners run, structuring trades to have an asymmetrical risk return. When done carefully, options can allow for an asymmetrical risk return, as the downside is naturally capped while the upside is often unlimited. It is important to not just track trade performance, but understand what positions you are taking and what is generating the most risk to minimize those positions. Doing this will allow for a more sustainable trading strategy and will ensure a positive risk-adjusted return when averaged out. To summarize, do not view volatility in one's portfolio as a negative. Look to track portfolio metrics to ensure use of strategies with a strong risk-adjusted return. Look to minimize downside while setting up an asymmetric payoff to the upside for a strong strategy. Thank you everyone for watching. If you liked this video, make sure to like and comment your thoughts on minimizing downside volatility. If you haven't already, make sure to subscribe and join our trading community found in the description below.